So Warren Buffett, after an incredible run at Berkshire Hathaway, is getting ready to hand over the reins. But before he does, he seems to be sending one last, very important message to all of us. And here's the thing, it's not in some big announcement or shareholder letter. Nope, it's hidden in plain sight, in what he's doing, or rather, what he's not doing.
And this is the message. A number so big it's almost hard to wrap your head around. $341 billion. That is the mountain of cash Berkshire Hathaway is sitting on right now. It's not in stocks, it's just cash, waiting. And this number, well, it's the key to everything.
So that brings us to the big question, right? The one we're going to dig into today. Why on earth is the world's greatest investor, a guy famous for finding amazing deals, choosing to just sit on all that cash? What is he seeing that maybe the rest of us aren't? His lips are sealed, but his wallet is wide open, and that speaks volumes.
Now, you might think, okay, he's just being careful. But it's way more than that. This isn't just caution. This is a playbook. See, he's run this exact play twice before in his career, and let me tell you, both times it led to some absolutely legendary profits for those who were paying attention.
All right, let's hop into the time machine and go back to 1999. The dot-com bubble was raging. Everyone was going crazy for tech stocks. And Buffett? He was on the sidelines, holding cash, saying that prices had completely lost touch with reality. People were literally calling him a dinosaur, saying he was washed up, that he just didn't get the new economy. He just calmly said we were heading for a lost decade. And guess what? He absolutely nailed it. For the next 12 years, the S&P 500 basically went nowhere, returning less than inflation. It was a lost decade, exactly like he said it would be. His patience paid off while all the tech-crazed partygoers woke up with a massive financial hangover.
Fast forward a few years, and you won't believe it. He did it again. By 2007, just before the huge financial crisis, Berkshire was once again piled high with cash. And when the whole system came crashing down in 2008 and everyone was running for the hills, what did Buffett do? He pulled out his checkbook and went on an epic shopping spree, pouring $20 billion into great companies when they were on sale.
Okay, when you lay it out like this on a timeline, the pattern just screams at you. 1999, hoard cash, market crashes. 2007, hoard cash, market crashes. And today, he's hoarding more cash than ever before. This is the key takeaway here. When Buffett stops buying, it's not because he's scared. No, it's because he's getting ready.
So what's he getting ready for this time? Well, this isn't just a gut feeling. His actions are backed by some cold, hard data. There are a couple of key indicators that he watches like a hawk, and right now, they are flashing bright red.
First up is a metric that's literally named after him, the Buffett Indicator. It's actually pretty simple. It just compares the total value of the entire stock market to the size of the whole economy, the GDP. Think of it as a quick reality check. Our stock price is getting way ahead of what the actual economy is producing.
Okay, now look at this chart. This is where it gets a little scary. Right before the dot-com bubble burst, this indicator hit what was then a record high of 140%. And today, we're at a staggering 177%, the highest it has ever been. What this tells us loud and clear is that the market looks even frothier today than it did at the peak of the dot-com insanity.
All right, metric number 2 is called the Schiller PE ratio. This one is a little more complex, but the idea is to smooth out all the short-term noise. It compares stock prices today to the average company earnings over the last 10 years. Basically, it helps you see past the hype and tells you if stocks are a bargain or just way too expensive from a historical perspective.
And you guessed it, the picture here is just as alarming. Historically, the average for this ratio is about 16. Anything way above that is usually a sign of a bubble. Right now, it's sitting at 33. That is more than double the long-term average. The point is, the data is telling the exact same story as his actions.
But, this whole thing isn't just about charts and numbers. It's really about people. It's about psychology. And Buffett has this perfect metaphor to explain what goes on in our heads when a market is at its peak. He calls it Cinderella at the ball.
And this quote just captures it perfectly. We all know the party can't go on forever. We know midnight is coming when the magic carriage turns back into a pumpkin. But the music is loud, everyone is dancing, and the fear of missing out, FOMO, is so strong that nobody wants to be the first to leave. And that's the real danger, isn't it? We feel the risk, We might even see the warning signs, but we keep on dancing. We're in a room where, as Buffett puts it, the clocks have no hands. Nobody knows exactly when midnight will strike. And where's Buffett in all this? He's not even in the ballroom. He's outside, with his $341 billion, just waiting.
Okay, so we've seen the history, we've seen the data, but you might be wondering, does this old school wisdom from Buffett still apply today? You know, in the age of algorithms, crypto, and, well, AI? So we wanted to know, what does a modern AI think about all this?
Well, the AI's verdict is in, and it's a huge validation of Buffett's entire approach. It's not magic. It's based on timeless financial ideas. First, something called mean reversion. It's just a fancy way of saying what goes way up eventually comes back to normal. Second, those valuation metrics we just looked at. And third, behavioral finance, which is the study of why we humans are so predictably irrational with our money.
Which of course brings up a really important question. I mean, if the strategy is so simple, just be patient and buy when things are cheap, why isn't everyone a billionaire?
And here's the secret sauce, the thing that really separates Buffett from the crowd. It's not a spreadsheet. It's what's going on in his head. He has the discipline and patience to wait for years, and he seems completely immune to FOMO. Most of us, we're on an emotional roller coaster. We get greedy when prices are soaring, and we panic sell when things look bad. We can't help it.
So, what does this all mean for you, for the regular investor? The conclusion is both simple and incredibly powerful. We can't know when the party will end, but we can prepare for it. That's it. Preparation. That is the only real, sustainable edge you or I can ever have. Okay, so how do you actually do that? How do you prep? Well, it boils down to 3 steps that look a lot like what Buffett is doing right now. Step 1, build up some cash. Have some dry powder ready. Step 2, focus on real value, on great businesses, not just the latest trend. And number 3, and this is the hardest part, get your head right. Be ready to act when opportunity arrives, especially when everyone else is freaking out.
And that really brings us full circle, back to this incredible piece of wisdom from Buffett's longtime partner, the late, great Charlie Munger. The big money is not in the buying or the selling, but in the waiting. Buffett's final message isn't a hot stock tip. It's a masterclass in discipline. So the real question he's leaving us with is this. In a world that's obsessed with constant action, do you have the patience to simply wait?